What's going on, everyone? I've been seeing on social media that, and the Discord as well, that apparently there's a video going around that there is a smile on AMC this week, and I was going to make this quick video just to inform you on some facts surrounding non-standard options and why this is the case, and just to equip you with the proper knowledge before you go buying way too expensive out-of-the-money calls with way too high of IV. So just pay attention for the next 2 or 3 minutes and you will learn about non-standard options and what's going on with AMC. So we're going to look at AMC's emotional state right now, smile or frown. I know Trades made a video, not any way against trades. He just may not have been aware of the full aspect of what non-standard options are. And I would definitely advise not to play them because they are risky and uncertain and very expensive. But let's go ahead and look into it real quick. So before you jump in, obviously NFA, consider the following. So currently on the options chains, we have 2 different possibilities for AMC. The only one for this coming expiration, or the 26th of August, is going to be for the non-standard options, or it's going to have a AMC 1 in the options chain. So the call smile that's being referred to, that's going around, is sitting at $16. Which is the lowest IV strike out of the money. Now, our group has been playing these, for that 4-week run that the tech had. That was amazing. But as far as non-standard, there is a huge difference that you need to be aware of. So, if you look back at the standard options real quick, there is no expiration for this week, at least unless my Weeble's glitching out. But there is one for September 2nd, and we have a conflicting put smile. So that's one thing to consider. But despite that, what is a non-standard option? That's the difference in those 2 chains. So basically, we just had a spin-off, basically, with AMC, which has the effect of creating a non-standard option chain. The creativity of corporate deal doers is almost limitless, and option adjustments must take deal terms into account. Thus, we see some very odd adjustments on occasion. Here are the options terms that can be affected by adjustment, and expiration is never changed, by the way. You got the multiplier, the number of shares deliverable or purchasable per contract. You have the option symbol, strike price. This is where odd strikes that you see in the chain for GME and AMC, like those 1325s and 1350s, 1375s. That is why that is happening. It's because they're non-standard. Number of contracts can change as well. The deliverables, cash, issuer shares, and shares of another issuer could be deliverable, and corporate events requiring adjustment and what changes. So the causes for adjustments to the terms of standard option contracts are numerous. The following table, which I'm going to show you in a second, illustrates the effect of various common corporate events, such as mergers, stock splits, and the like. There is no need to memorize this table, but be aware of the process OCC, which is the Options Clearing Corporation. It's the buyer to every trade and the seller to every trade. And it's what they use to keep the adjustments fair to all parties. So we're going to pause real quick and look at that. So this is the table here. It's a option adjustment for corporate events. This is from a cited work. I'll link it in the description below if you want to take a read. But basically, it gives you an event here like stock split even, stock split odd with cash, reverse stock split, and make sure if there's a little number here, you read it, what that is. Stock dividend. The only one that doesn't affect any of the metrics here is going to be your ordinary cash dividend, which neither AMC or GME had. So we had basically a spin-off, which you can see here based on this table, that symbol changes, yes, AMC 1, strike changes, no, and we have contracts changes, which is yes. The number of contracts changes, which is yes. So that's basically what is affected, and then you have a maybe on cash paid. So that's the table that was referring to in the PowerPoint. Continuing on here. So what are they? These are options that don't have the standard terms of an options contract. That's where they come. That's where the name comes from, non-standard. Namely 100 shares as the underlying asset. They are normally created as a result of a specific event such as a merger, acquisition, spinoff, extraordinary dividend, or stock split. We just had an AMC event, so this is why this is occurring. As a result of the changing circumstances, the contract is adjusted to be equitable to both the option buyer and seller. by equating the new underlying assets of equal value as the owner of 100 shares. The Depository Trust Company, or DTC, determines how the shares will trade pre-event, while the OCC, or Options Clearing Corp, decides how these changes will be reflected in the options. Each situation is unique and therefore non-standard. This makes them difficult to understand, and therefore risky to most investors. In the above hypothetical, one contract was a standard options contract, the other non-standard. The standard contract represents 100 shares. Okay, we're not going to get into that. I'm going to show you the difference here in a second. But it says here the obvious rule is to avoid all non-standard options. Let me add another. If an option value seems too good to be true, it likely is. These contracts will also show odd strike prices and different root symbols. So the point is, you want to make sure that whenever you hear stuff like this going around on the internet involving investments or, stock options, that you don't just want to go with, oh, there's a smile, that means moonshot to, the smile strike. Not at all. You got to weigh all sides, and the fact that we have a non-standard option here needs to be discussed and considered if you are planning on maybe purchasing a deep out of the money non-standard option, which are extremely expensive. And with the IV the way it is, very, very high, I mean, IV crush is almost guaranteed. So, and one more thing, an additional fact about non-standard options is that they are illiquid, which I'm going to demonstrate here in a second. These contracts are often illiquid and difficult to trade. In this chart, we can see the volume of the standard contract is 39.90. Okay, there's not going to be a chart. Well, I'm going to show you the Webull options. When evaluating the liquidity based on open interest, one can easily be deceived, as many of those option holders had their contracts since prior to the merger, or spinoff, or acquisition, or whatever else you had. Most likely, there has been little activity in them since. So, that being said, if you look at the options chain, non-standard versus the standard for AMC, I mean, look at the bid-ask spread. Right here at the money for the standard, you're talking about a 10-cent and a 4-cent spread. Here, I mean, a lot higher of a spread between the bid and the ask here. 630 to 710, 605 to 660. That represents liquidity. Obviously, this one here has way more liquidity because it has a tighter bid-ask spread. This one here has way less liquidity because there's way bigger of a spread. And that's basically all you need to know about non-standard options. It's not the same mechanics as your standard options, so just take that into account. Obviously, you do what you want to do. I'm not trying to control anyone, just trying to inform you of what you should know before considering purchasing non-standard options, especially out of the money. Have a good one.